Okay, there was an error that occurred. Let me try it again. Awesome, awesome. Now we're good. All right, it is Monday, and we are back once again with Create Your Future Self Live. Thank you guys for joining us. As you know, we come on every Monday evening at 6 p.m. Central Standard Time with our show, Create Your Future Self. And through this show, we hope that the viewers will be able to gain valuable insight and information on, indeed, how to create their future selves. Whether you want to become a better business person or whether you're wanting to become an entrepreneur, our goal is to give helpful hints and tips to help you reach that goal. And tonight, joining us is Miss Adina Collins. And Miss Collins is an amazing entrepreneur out of the Dallas area. And she'll be sharing wonderful tips with us tonight on business taxes and things of that nature. And our co-host, Mr. Victor Johnson, he'll be joining us again shortly. But right now, Miss Adina, if you would, please introduce yourself to our audience.
Sure, no problem. Hi, good evening, everybody. I'm Adina Collins. I am the CEO of Fortitude Financial Consulting. I've made the entrepreneurial leap about 2 years ago. And it's been quite an interesting journey so far. I primarily offer 3 types of services in my business. It's virtual CFO, virtual Chief Financial Officer services, financial coaching, and also business advisory services, which also includes tax prep as well as tax advisory. So different ways that I can help to save you money legally on reducing your tax liability.
Awesome, awesome, awesome. You know, my journey as my husband and I, our journey into becoming real estate investors, it began many years ago, but our most recent self-education piece that we added to our was joining Robert Kiyosaki's Elite Legacy Education System with their real estate investing, and something that you mentioned by tax liabilities. That's one of the foundational principles that we learned through the Robert Kiyosaki's Elite Legacy Education is that there are many tools to obtain wealth. And of course, owning your own business is one of them. And when that business is able to earn money without your actual day-to-day hand in it. But yes, one thing that most your average individual doesn't understand is taxes. The reducing our tax liability plays a major role in the amount of income that we're able to retain. And that was actually one of the questions that I did have for you today. Could you give us a little bit more insight into and help us understand how minimizing our tax liability, why that's so important?
It's definitely important. One, as you well know, a lot of W-2 employees have been tremendously impacted because of the changes in the last 2 years to the tax code. So that means that a lot of working regular folks no longer have the same type of access that they used to regarding their ability to be able to write off things such as W-2 employees who work from home. They were no longer able to be able to write off the use of their home office if they had to telecommute. They also had different people who maybe had to pay for their own supplies out of pocket or pay for union dues out of pocket, and it was a required part of their job that was, not reimbursed. And so they're unable to be able to reduce, their tax liability. And of course, because of the tax law changes, and also the fact that you're unable to be able to write off the total amount in some cases of what you may owe and what you paid in property taxes or what you paid in other state and local taxes, it becomes even more important that people have another means to be able to not only increase their income, but at the same time be able to offset what they may owe to the federal government. And so, of course, if you're able to reduce what you owe to the feds or to the state, that puts more money back in your pocket.
And back in your pocket. Awesome.
Yes.
Awesome. Sometimes we're having that conversation, and we talk a lot about mindset here. And when we're having that conversation about understanding what can be a tax write-off and how to lessen your tax liability, I've found that many people don't quite understand that that is legal. And yes, tax law is there for us to use as entrepreneurs so that we can remain in business. Can you talk to us a little bit about that to kind of help people to shift that mindset from,
Sure.
oh, these are just loopholes and the IRS is going to, come and get you, all of these things that, that
Sure.
you probably hear every day when you have a client or a potential client sitting in front of you. What are some of the things you could say to help alleviate those fears?
Sure. Well, one thing that you can be encouraged about, again, because of so many different changes that have happened recently with the tax code, is that really the tax code now is quite honestly geared towards business owners.
Mm-hmm.
So the tax laws were really already in place that benefited business owners. And so, as a business owner, whether you are a full-time entrepreneur, a part-time business owner, you're just doing a side hustle or side gig, it is absolutely your right to be able to take advantage of what's been written into the law. It is indeed legal. It's not about trying to get over on anything, but the most important thing is being able to work with someone who is aware of what you can legally write off, be able to keep up with any changes in the laws, as well as to help you to stay organized throughout the year. So if you're able to position yourself earlier in the year so you can know what different write-offs are available to you and be able to also put yourself in the best position to be able to maintain your own records throughout the year, that's going to put you in the best space to be able to maximize what you can use for your write-offs. And so, listen, America is indeed a free enterprise, country, and we should be able to not only have the right to be able to create the businesses that we want and to be able to create the lifestyle that we want, but also be able to take advantage of what the U.S. government, your lawmakers, have actually put in place to ensure that businesses have a fair shake. Because quite honestly, small businesses make up the majority of business in this country.
Yes, yes.
And so small business owners should be able to, because we are creating and stimulating different parts of the economy, we
Yes,
should be able to benefit from that.
absolutely. Absolutely. I 100% agree with that. Small business, um, in economics 101, whether you're in high school or your bachelor's degree, that's one of the first things that we've learned about the foundation of America, that we're very much built on the back of small business owners, and it's small business owners that keep our country going, that keeps our economy going. You want to put a stimulation into the economy, we have to do that into small business. And I really love that you brought that out, because as small business owners, us being able to support one another in what we do, it stimulates the economy, and it also helps us in terms of myself as a real estate investor and small business owner. I own a call center and we employ people. Not only am I providing jobs, but at the same time, in order for me to continue to be able to provide jobs for people, in order for me to be able to continue to provide affordable housing for those that need it, my business doors have to stay open. And
Yes.
me being able to patronize a small business such as yours, that gives me the services that I need, that and also provides me those services, and you are knowledgeable and up to date on all of the current laws, that helps me stay, I don't want to say competitive with the bigger companies, but it helps me stay competitive with other small businesses, so that my doors can remain open, my contractors can still earn a living, and my tenants can still have a place to live.
Yes.
So we have to be able to do that. I like to just take this moment and let everyone know that please join into the conversation. We would love to have your questions and any input for Ms. Adina. If you have any questions about taxes, if you have any questions about how to keep yourself organized and together with your daily bookkeeping, anything that's relevant to your business's day-to-day function, the back office part of it, not just your products and services, about how you run your business, please feel free to join the conversations, ask those questions, put forth those comments, and we'll be more than happy to answer them on the broadcast. My next question for you, Ms. Adina, would be, as a real estate investor for myself, and I know Vic is an investor as well, and any investors that could be watching today, what would be your advice as a real estate investor? What's one of the top tax strategies that we can use in 2020?
Sure. Well, one of the best tax strategies actually for real estate investors is called cost segregation. And so literally you are taking a look at any purchases that you've made, whether it's a residential purchase that you may be using for a rental property, or if you've actually bought a commercial building. And so before I get into exactly what cost segregation is, let's just speak about in general real estate purchases. So of
Okay.
course, most real estate purchases are divided between the actual land and the building that's put on the land. And so land is never depreciated. And for those people who don't know what depreciation means, it just means that over time, different assets begin to wear out.
Okay.
And so on your books, you can literally begin to write off a portion of, the normal wear and tear that would happen on a building, on a car, on, different types of assets that obviously have a useful life over a certain period of time. Well, buildings tend to depreciate over time. Of course, the great thing about what you do with real estate investing is that you do make investments. You can buy a house, you can flip it, you can, decide to go ahead and make different improvements with it. And so the government will allow you just for the building itself to be able to reduce the building on your books and also be able to claim a tax deduction for depreciation on that. And so usually for residential buildings, you can normally depreciate that building or reduce the cost each year on your books for 27 and a half years. That's just for a residential building. For non-residential buildings or commercial buildings, if you will, you can actually write off the cost of that building, the depreciation on that building over 39 and a half years.
Wow.
Well, of course, if you've put into different improvements on that building, you may, find, hey, listen, I have taken on all of these different expenses. Maybe I've improved plumbing, I've improved the electrical systems, I've put in accent lighting, I've done all types of other things, maybe even encase any dumpsters. I've added in sidewalks, I've done landscaping, things that really do improve not only the interior, but also the exterior of the building. Well, the federal government allows you to do what's called a cost segregation study. And so literally you can break up not only the cost of purchasing the building, but then also you can also write off a little bit faster some of the improvements that you've put into the building or to the outside of the building to make it, more accessible for people to be able to, access. You're adding on to the total value of, that particular property. And so the great thing about being able to do a cost segregation study, which you would need to have someone who's qualified and understands the IRS tax rules regarding how to break down and break out those particular costs, is that for those additional improvements that I mentioned, you can actually write off some of those costs over 5 years, 7 years, or even 15 years, so you can speed up the amount that you're writing off.
Awesome.
Instead of just taking the annual depreciation amount on the building, but what you've actually put inside of the building or what you've put around the building can actually be written off a little bit faster. And so from an accounting standpoint, land never depreciates. If you've bought the land and there's really no change in the market, the land value, at least according to the accounting standard, still remains the same. You
Okay.
never write off land per se. It shouldn't go down in value on your books, but the cost of the building would. And so, again, if you have higher depreciation costs, the great thing is that that's helping to reduce your overall tax liability because your depreciation costs are going up, which means that, again, it's going to be a direct effect on the total liability expense, along with any other type of tax deductions that you may have, tax deductions and credits. So that's always a great thing for you to be able to know. It's recommended usually if you are buying new construction or if you've made major improvements into a property, it's really recommended that you go ahead and invest in that cost segregation study if you can, at least a few months up to 1 year after you've done that, so you can take advantage of the full write-offs, maximize those write-offs as quickly as you can regarding that. And so the cost of the segregation study may vary depending upon which provider that you're working with, which tax advisor that you're working with. It could be anywhere from a few $100s to a few $1,000s. And so you would pretty much just have to, be able to take a look at that. One thing that as I was preparing for this particular broadcast, I noticed that there are different cost segregation calculators that are available if you Google them. You can get a free cost segregation calculator, but again, I would definitely recommend that you work with a tax pro that has specific background in cost segregation studies, so that you can work together. But certainly it would be helpful if you had information that you're also bringing, collaboratively to them, so that they can also work with you to make sure that you're taking full advantage of being able to write off those costs.
That's awesome. As a person who is a real estate investor, that's an amazing piece of information.
Yes, absolutely.
Amazing piece of information to have. And I actually did not know of that, but yeah, we'll definitely have to have a conversation. So that sounds like something, and please jump in anytime, especially I know I'm about to be wrong on something here in a minute, but that sounds like something for those of us that do buy in wholes, that because every tenant, after to get the property ready, we have to do things to it. While the tenant is in it, we have to maintain these things constantly. And then when the tenant leaves, again, there's still things that has to be done continuously on those rental properties. And if you're one that holds, if your portfolio has quite a few rental properties, this sounds like a strategy that that we, those of us that are landlords, could definitely benefit from.
Absolutely. The other thing that you want to keep in mind too is what is a real repair versus what's an expense. So for example, if you had a tenant that moved out and you knew for sure that you were going to have to repaint walls, you were going to have to strip the carpet and be able to replace it, for the most part, depending on how you choose to classify it, it could be either or. However, if you end up classifying it honestly as an expense, and it's an allowable expense, that also helps to be able to reduce your tax liability as well. So real estate investors definitely want to be more aware of how you choose to classify your accounting expenses, whether or not it's truly a repair versus a expense that actually is helping to improve the overall value of the property.
So my next question will be, when we're, as real estate investors, when we're doing these things, then what I'm hearing from you is it will be advisable to me. I know I have my system on how I determine what a property is going to be, what my exit strategy is going to be with that property. But I also now need to have more frequent communication with my accountant or tax person, so that I can actually put those in the right categories of what it would the best benefit me, instead of me just saying, okay, this is what I'm going to do, and then doing it.
Absolutely. And of course, we know that properties are bought and sold all throughout the year. And, the thing is that, say, for example, you end up selling the property during the middle of the year. You definitely want to make sure earlier in the process, for those folks that don't frequently update their accounting books, that you want to make sure again that you are, you don't have to just communicate with your accountant on a, quarterly or semi-annual basis. Definitely try to do it as frequently as you can. And especially as issues like this may come up, they will definitely be able to make sure that you are indeed classifying the expenses correctly, and that they are also helping you. If they don't prepare your taxes, then whoever your tax pro is or your tax advisor is, then they can also make sure that they are working with you to make sure that they have the best type of tax plan in place, and that you are making sure that you're communicating that with them, so it's not a big surprise at the end of the year when you have to file your tax return.
So as real estate investors, one of the things that I encourage my clients to do, because I do real estate coaching, is to build a power team. And having an accountant and a tax and a bookkeeper they're viable members of that power team. But now it seems like I'm going to make some adjustments in that, meaning I really encourage them to have frequent conversations with their contractors, their realtor,
Yes.
real estate agents, all of those people with the actual buying and selling. But
Yes.
now, hearing this, especially with this particular strategy, having that continuous open line of communication
Mhm.
with your accounting and your bookkeeper, your tax professional, whichever one that you have, is absolutely necessary
Yes.
in being able to lessen their tax liability, which
Mhm.
overall will help them get to where they want to be in terms of building wealth.
That's correct.
Oh, that's
Absolutely.
awesome. That's awesome. So
Absolutely.
from the landlord side of the house, well, okay, what about from the for that person that fixes and flips? I'm buying it and I bought it for 30,000. It's really worth 30,000, but by the time I finish, it's going to be worth 120,000. Is this a strategy that that flipper can use as well?
Well, if you're holding it for a little while longer, it's not something that you've immediately sold, within the same year.
Mhm.
Then, honestly, if to me, especially when it comes to non-residential properties, such as the rental properties that you're
Mhm.
speaking of, honestly, the cost segregation strategy would probably be better suited if you knew you were going to hold on to the property for a little
Okay.
bit longer.
Okay.
In reference to any gains on the sale of your of the houses that you may flip,
Mhm.
yes, you would definitely be taxed on the gain between whatever you bought the house for versus what you sold it for. But again, the great thing about as you're beginning to do that, if you're frequently communicating with your tax advisor or with your accountant, then again, they can say, well, listen, I realize that you may have this particular gain on the sale of this house, but let's also take a look collaboratively, corporately, at all of the other things that are happening that may be able to help offset, any tax that you may have on that gain. So yeah, but honestly, for the cost segregation piece, it's really for longer held properties versus just the fix and flip.
Awesome, awesome, awesome. That's some great information, guys. I hope that all of our listeners are have their pencil and their paper out and they're taking notes or at least coming back and going to rewatch this broadcast later because you've given some great, great value there to the investor. Absolutely. Uh, the next question would be what are the top three overlooked tax deductions for entrepreneurs and business owners? Of course, we have people watching the broadcast that are not real estate investors; they are entrepreneurs. So, what are those three most overlooked tax deductions?
Well, the first one that I'm going to mention, which people would probably say this is kind of obvious, but it's really not, business mileage. Business mileage is one of the best tax deductions that entrepreneurs and small business owners can use to their advantage. If you are required to frequently travel using your own personal vehicle, or if you're having to, if you have your own company cars and you're having to put a lot of mileage on those vehicles or on trucks and whatnot, you definitely want to be able to capture that business mileage. One of the best ways that you can actually track your mileage is by using downloadable apps on your phone and allowing those apps to go ahead and track the mileage as you travel. So I have about three recommendations that you may want to take a look at. There's much more that's out there, but QuickBooks Self-Employed actually has a great app that you can download the app to your phone and be able to classify those trips every day, whether it was personal versus business mileage. Also, Mile IQ is also a great one. It'll allow you to have up to 40 free drives per month. And then if you have anything over, you can pay, I believe it's maybe $5.99 per month, $5.99 per month
Okay.
to be able to get the unlimited amounts. And so literally you can swipe, I believe, to the left and you can indicate, yes, this was indeed a business trip, or swipe to the right and it was, a personal. So you can definitely do that. And the great thing is that it's tracking by day. It's tracking the points that you've traveled in between the total mileage that you have. And so literally what you can do at the end of each month is be able to download a PDF copy of your trip reports. And that way it's keeping it up on a regular basis. And if the only bad thing is when you forget to go in and make sure that you're properly classifying those trips. And so what I normally recommend that you do for that is at the end of your day, if you're too busy to be able to classify all of the drives, just take time at the end of the day before you leave the vehicle and just say, hey, listen, I'm just going to make sure that I classify all of these drives. And that way I know it's already
It's
taken care of.
yeah.
And so if you have that, that'll be great. Also, another free app is called Hurdler. It's Hurdlr, and it's another great free app. And again, you have a certain number of drives up until a certain point, and then you can pay for that particular app. And I believe it's also around the $5.99 to maybe $7.99 per month. And so it's a great thing to be able to have. And so if for some reason you just do not feel like going the electronic route, you can still go ahead and maintain a manual mileage log. However, just keep in mind that as you keep up that manual mileage log, the IRS is looking for specific information regarding the business mileage. So if you keep a manual log, whether you decide to create an Excel spreadsheet or you decide that you want to actually print out a spreadsheet that you can keep on the clipboard or whatnot and keep it in the car, then just keep in mind that the IRS wants to see the date that you traveled, the odometer readings, the beginning and the end odometer readings. They want to be able to see the total number of miles that you traveled for that day. They want to see what was your origination point, any points that were traveled in between, and your final ending point. And then they also want to know what's the business purpose of this trip. Okay. So it's a lot more information that you're going to have to do. But quite honestly, you win with business mileage, because a lot of people think, well, hey, I'll just go ahead and capture any maintenance that I have on the vehicle. Well, sometimes that's great. But quite honestly, you end up getting a bigger bang for your buck in reference to the tax deduction for business mileage, because in 2020, you can actually deduct 57.5 cents per mile.
Wow.
That is big. And so again, if you're traveling frequently in your town, around the state, around your region, or even across country, think about all of the mileage that you were racking up and how much you were legally able to write off for that. The other thing that I wanted to include with the travel piece is I am physically located in Metro Dallas. And if you've ever traveled to Dallas, we have, I believe, 3 tollways here. And if you are going back and forth using tolls, paying for tolls, I'm sure Houston, has a lot of tolls as well. Yes, just keep in mind that if you're traveling and you're having to pay for tolls related to your business meetings, those are 100% deductible.
Okay.
One of the great things that especially if you have an Easy Pass, if you have a Texas toll tag, if you have up here, it's an NTTA toll tag, you can actually go online, download your readings. And so literally you can download your reports, your toll tag reports on a monthly basis. And so if you can do that and go ahead and highlight what those tolls were, then you already have a running listing that'll definitely help your tax preparer as well as help you out regarding that. So you definitely want to take advantage of that. Wow. The other types of travel expenses that you also want to keep in mind too is, are you traveling for business conferences? Are you having to take continuing education courses to be able to maintain your licensure, or just to be able to keep up with your trends and different things that are pertinent to your particular industry? Are you having to fly out different places? Do you have to take taxis, Ubers, Lyfts? You definitely want to be able to keep all of that. And that is definitely your lodging, of course, your hotel lodging is definitely tax deductible. And so I would say this: if you are attending any type of continuing education conferences, if you're having to attend any business conferences, keep a copy of your conference itinerary. That way it is proof that this was indeed something that was real. You paid for registration for it, you paid all of this stuff, and you're able to tie back any of those travel receipts back to that itinerary. That is just extra backup for you, just in case you may happen to be audited. It's not a guarantee that you're going to be audited, but I'd rather have more information than not enough. Not enough. Yeah. Right, exactly. Exactly.
Absolutely. Wow. That 57.5 cents per mile?
Yes, 57 and a half cents per mile. Last year, if you actually were keeping up with your mileage, you would have been able to deduct up to 58 cents per mile. So it just went down a half cent from last year. But again, it's a great opportunity savings for you. And you definitely want to keep that in mind. I'm going to keep going a little bit more, Lakita.
Okay.
That's going to kind of tie back in also to some of the business travel.
Okay.
The next thing, that was tip number one for overlooked deductions. Tip number two is keeping up with your business meals. So if you have invited someone out to breakfast, lunch, dinner, or out for coffee or tea, you can definitely deduct up to 50% of the total cost of that meal or that drink that you've had with the person, as long as you have discussed business, legitimate business during that particular meeting, and you've paid for that. Keep up with your receipts. You definitely do not want to overlook that. I'm going to tell you, a lot of people in the past, before the tax laws changed 2 years ago, they ended up also paying for entertainment expenses. And when I say entertainment expenses, to be able to maybe court a new client or to be able to reward an existing client that's been working with you for a while. Maybe they bought basketball tickets to a local game, or they decided to treat you to maybe a movie or some type of theater event, maybe a concert, something like that. Well, in the past, the IRS used to allow you to deduct a certain percentage of those entertainment costs. Well, now, unfortunately, you can't deduct any entertainment cost. However, again, with the business meals, you can still be able to take advantage at least of 50% of that. Now, with an employer like yourself, Lakita, because you do employ employees, you actually have people that are housed, in an office.
So actually, actually with that, I don't. I
Okay,
hire individuals as independent contractors,
gotcha.
and my
Okay.
independent contractors actually work from home. So
Oh, okay, great. Okay,
they
okay, gotcha.
they answer
Okay, well,
customer service calls for some major companies here in the U.S. And they're able to work from home.
oh,
So
okay, perfect,
these are
perfect.
the tips that I love to share with my contractors because um, one, they need it because they are self-employed. So,
Yes,
and your home is your office. Your home is where you do your work. So, not
yes.
only do I want to be able to provide for you income, but I
Hmm.
also want to be able to show my contractors how to keep some of that in their pockets at the end of the year.
They absolutely need to have it. Yes. Well, I'm going to say, since you do not physically house employees, but maybe others that maybe
Yes.
tuned in may.
Yes.
If I'm still on the business meal example, if you happen to have a particular business meeting, a business training, maybe an in-service type of meeting that requires all of your employees or a significant number of your employees to be able to attend a meeting that is for business operations, and you decide that you do want to buy a meal from them. Maybe you want to get lunch because it ends up becoming a working lunch. In
Mhm.
that case, because it would have been for the best interest of the business to be able to operate and to continue things on, then you
Mhm.
could deduct up to 100% of that employer paid meal that
So,
you brought in.
so for my agents that are local, because I do have a number of agents that aren't here in the state, but for our agents that are local, if we have our quarterly, I call them meet and greets because we don't get to see each other as a team. But we have our quarterly meet and greets, and I take them out and buy a meal and we discuss any changes, and I'm available to answer any questions, things of that nature. That's something that I would be able to write off.
If it's a mandatory meeting that you had,
Mhm.
or you say, for example, instead of you necessarily just taking them out to just a restaurant, but say you ended up having a meeting, say at a hotel space, or you ended up having a meeting maybe at another type of meeting space, but
Okay.
it was a required meeting that that they had to attend,
Okay.
and it really wasn't feasible for y'all to be able to leave that meeting in order for you to be able to continue your business operations. You can
Okay.
definitely be able to justify that. I would definitely keep a copy of your meeting agenda. So it's not just, hey, I decided that I wanted to treat my employees out to a meal,
Mhm.
but definitely that you are showing that there was indeed still business operations that was happening. They were required to be able to attend the meeting, and it was, still, part of your normal business operations because you couldn't do it otherwise,
Otherwise.
then in that case, I would definitely say that would definitely be an allowable.
Awesome. Awesome. Vic, you made it.
Hi, good to
Man,
see you.
let me first apologize, Adina. This has been the worst afternoon for me as far as being on schedule. I had an appointment that was supposed to be at 4:00, which would have been plenty of time. So again, I just apologize. I hate to treat my guests like you're second hand because you absolutely were not.
Oh, no, I completely understand. Listen, if it had to happen, it was going to happen on a Monday.
Absolutely. And I apologize to you too, Laquita, because this is my first time being late for one of these in a year and a couple months. So I apologize. And I see some notes here. I'm already taking notes from cost segregation for real estate investors.
Oh man,
I have the QuickBooks.
You don't know. I'm gonna tell you to go ahead and rewatch the broadcast.
Oh, you already know I'm gonna rewatch this like in the next 20 minutes.
Yeah. I was over here just typing away, like, wait a minute.
Nice. I don't want to ask any questions because I know you probably already covered all of those. So continue on. Yeah.
We're still working our way through. So the business meals was tip number 2. The first one was the business mileage. Tip number 2 was actually business meals. And so tip number 3 is actually if you have an SEP IRA. And that is literally a simplified employee pension plan. So if you are indeed self-employed, you own your own business, you can actually open up a special IRA because you are indeed a business owner. And the great thing about being able to open up that IRA is that you are able to have higher contribution amounts. And it's also tax deductible. So if you opened up a traditional IRA, a traditional or a Roth IRA as an individual, in 2020, the maximum amount that you could actually contribute to either the traditional IRA or the Roth is $6,000 for the year. If you're under 50, but if you're over 50, you can actually, if you're 50 or over, then you would be able to contribute up to 7,000, which is not bad. But the great thing is that as a business owner, if you decided to open up an SEP IRA, you can actually contribute the lesser of $57,000 per year, or 25% of your employee gross earnings. So if you paid yourself a salary, then you could go ahead and contribute up to 25% of whatever you earn from the business. So that's great. I mean, it actually puts you in a better position. It's also helping you to create wealth, and create wealth. You're using your business to be able to create your retirement. One of the worst things that I've seen business owners do is keep all of their money within the business for retirement. And they think that once I go ahead and get the business to a certain platform, I'm at a certain valuation amount, then I'm just going to go ahead and sell it, and I'm going to take the money and run, and I'll just live off of that. Well, here's the thing. What happens if the economy shifts? What happens if someone's not necessarily interested in buying your business, or if you're in a tech field and the technology has drastically changed, equipment's become obsolete, different things have happened. Maybe you may be able to sell your business, but maybe it may end up being for a smaller amount than what you anticipated. So it's better for you to try to be as proactive as you can. Not to say that you can't use strategy when you do sell your business, but you want to, along the way, be creating and making sure that you have retirement built up outside of that business. So that's definitely one of the things you definitely want to keep in mind as well.
So I have a question on that, if you don't mind. So does entity play a part in this? What type of entity you are?
It does not. As long as you can show that you definitely do have a business, pretty much you can work with a certified financial planner, or you can work with a certified financial advisor who is licensed to be able to open an IRA for you. They can definitely go ahead and take you through that particular process. And the great thing is, if you want to have both a traditional or Roth IRA and your SEP IRA, the IRS does not care. So you can double dip.
My wrong.
Yes. So you can double dip.
Yeah, all right. Okay.
You can have both. They do not have any caps in reference to you can only put this amount. If you choose to open up the SEP IRA, then you have to choose. You do not have to choose. So if you want to max out what you have for the traditional or Roth IRA at the 6,000 right now for 2020, and if you wanted to max out whatever you can on the SEP IRA, even better.
Awesome.
Very nice. Very
Yes.
nice. Oh
Yes.
man. So we need a weekly segment with Adina.
Like at least once a week we have you on. Twice a
Well,
month.
I'm definitely honored. I'm sure we will never get tired of tax topics. And one of the misnomers about tax is that, oh, tax season is only between January and April. Not true. Tax season is year round.
Right.
And so, if you are only focusing on the first quarter of the year, then you are definitely missing out because so many different things end up changing. And again, as Lakita was talking about, listen, let's make sure that I'm communicating frequently with my accountant. Let's make sure that we're communicating, with your tax pro, because again, maybe something may have changed for you. Maybe you've added on something brand new, or you've decided to maybe close down a division or be able to shift what your offerings were before. Let's see how much of an impact it could make, potentially on your tax liability. So yeah, I'd be glad to be able to come back and answer some more questions for you.
Absolutely. So maybe this came up earlier in the conversation. So when a company, or there's a lot of entrepreneurs out here that are service-based businesses,
Yes.
Barbers, or they're maybe a designer or something like that, and they start out as doing business as a DBA. Any guidance for them? And again, forgive me if this has already come up, but any guidance for them for transitioning their tax situation? What will be the best way for them to set up?
Honestly, a DBA, again, just the doing business as, really doesn't offer you any type of legal protections. That's like me saying, hey, I'm Adina Collins. I'm going to use my individual social security number to be able to set up a DBA. I'm going to do business as, make money entity, right? So here's the thing. When it comes down to tax purposes, all of those monies still have to flow through my individual tax return. If I am set up as a sole proprietor, meaning that I am the owner of that, I just decided I wanted to go and do my side business. I have not gone ahead and gone to the IRS and requested a free tax ID number for my, for my business, whether or not I've, filed my state paperwork or not. The fact is that you have not separated your individual self from your business. And so literally, if what happens is that even if you set yourself up as a DBA, as a sole proprietor, if someone decides that they want to come and sue you, they now have the right to be able to sue you and to be able to potentially put liens on your personal assets. If you own a house, if you own a car, if you have, any other type of personal property of great value, then literally they can come and attach themselves and say, well, hey, listen, I'm just going to go for all of their personal assets because I don't see anything on here that's associated with a business. The great thing about going ahead and applying for your free tax ID number through the IRS, you can actually apply online in less than 5 minutes and be able to get a free tax ID number from the IRS. You can go ahead and complete your filing paperwork with the state at a later time, but at least start to begin separating your personal assets from your business assets. So it's one great way to be able to do it. Again, pretty much you are wide open, in reference to potential liability, if you have lawsuits or anything like that. Whereas if you would have created maybe a limited liability company or an LLC, literally you are separating yourself. The limited liability company or the LLC is a separate entity. So if someone decided that they wanted to come back and try to sue you, then your personal assets are protected. And so, it would pretty much be looking at what your business assets may be. But, say, for example, you decided that you needed to open up credit in your business's name. And for some reason, maybe business was slow or whatnot, and you were unable to be able to repay. The good thing is that if that particular credit card or business loan was actually in the business's name and not in your name, and it was under the business's tax ID number, there's a greater possibility that if one, it's not going to appear on your credit report, because your credit report only reports your personal. Yes, your personal credit items, whereas this was actually related to the business. So again, you are trying to protect yourself in as many ways as you can. And so whatever you can do to start putting things like checking accounts, credit in, your business's name, making sure again that you are indeed set up from a tax standpoint as a separate entity, that is the best thing.
Awesome. We have a question here from one of our users here on Facebook, and the user asked for Adina, is it true that you can file up to 3 years back on your tax returns?
I know of people that haven't filed their tax returns in 10 years.
All right. Well,
now, here's the thing. We don't recommend that you wait that long, but it has been known to happen. But here's the thing. If you happen to know that during those last 3 years, say, for example, if you didn't file over the last 3 years, if you happen to know that you would have been eligible for a refund, as long as you file within 6 years of when you knew the tax year that you knew you would have had the refund, you can still get it.
Would it be
which is great
without a penalty?
If you don't owe, there's no penalty. If you owe, of course, the penalties begin to, accrue every month. And so typically the IRS will tack on an additional 5%, usually per month, up until they reach like a 25%, threshold. But whatever you can do, the IRS will allow you to set up payment arrangements online. They can definitely go ahead and work with you. But try, if you can, to start getting some of that, the back taxes going ahead and filed. Here's the good thing. If you happen to have, again, if it was 3 years, if you happen to have received, if you know that you were going to receive a refund for one of those years, but for the next year you may owe, don't worry, the IRS will just snatch.
Yeah.
They'll just go ahead and snatch whatever the refund amount is and apply it. Yeah, snatch. And so, they'll just go ahead and snatch that and apply it to whatever the tax liability is, that you would have owed for that. So, don't be discouraged. Again, unfortunately, you're not by yourself, and there's a high percentage of people that have not filed in a number of years. So,
okay. Now, I do have a question as it relates to asset protection from the entity. Just the LLC, S Corp, C Corp. One of the things that I've learned is that, and just want your perspective, that for a real estate investor, it would be advantageous of us to have a C Corp. And I learned that at a conference, but when I come back to try to get that established, it's been really hard to get someone to set up a C Corp for me. Can you speak on that a little bit?
Well, C Corps, for those who are unaware, are pretty much corporations. And so corporations, whether you're a small corporation, which is an S Corp, it's usually has less than 100 shareholders. And if you have a C Corp, which is a larger corporation, you can have beyond 100 shareholders. The thing is that it depends on what your overall desires are regarding your financial goals, and also what direction that you feel like you're going to go for in your business. Quite honestly, not going the LLC route is great, because unless you specifically say that you don't want your LLC to be treated as a pass-through entity, meaning that whatever income that you receive from that business passes through to your personal tax return. You can actually choose for the LLC to be taxed as a small corporation. A lot of people don't know that. You can actually file the paperwork with, it's just one small form. I think it's a form 2553 that you can file with the IRS to request that your LLC be taxed as a small corporation, which also means that you have other corporation type of protections. It requires you to actually file a separate 1120S tax return instead of that having to flow through to your personal tax return, which is great. You can have all of the business income and all of the business expenses completely captured on a different tax return. In reference to the corporation, quite honestly, if you're an S Corp or you're a C Corp, just depending on what you want to do, the great thing is that with the changes in the tax return, in the tax laws, now corporations are being taxed at 21% flat. So it doesn't matter how much that you've made, the overall tax rate is still going to be 21%. Again, it just depends on what you want to be able to do, what what your goals are, I guess, in reference to whether or not you think that you may end up having other entities that may end up being under that large corporation. If your corporation may be a holding company and you just want to be able to say, well, hey, I have this particular corporation here. I want to be able to establish these all small little companies that still kind of report up to the holding corp. It just depends on what you really want to be able to do. But I would say either the S Corp or the C Corp would be, a great way to be able to do it. I know also too, depending on which state you live in, where the three of us are here in Texas. I believe in Texas, it costs maybe $750 to be able to file for a C Corp with the Secretary of State's office. Whereas, if you're just doing an LLC, it's like $300. And then again, you can elect to treat that LLC as a small corporation if you want to, and still be able to have the same type of protections as a corporation.
As a corporation.
Right, exactly.
We have two more questions from some of our viewers. The first question is, this particular viewer is a realtor, and their question is, what do you suggest is a good percent to deduct from each transaction that they have because they are a realtor, before or after they put it towards an IRA or 401k, and that person has an LLC?
Honestly, it's going to depend. I would definitely say that if you think about it, if you were employed by a company, they would have gone ahead and taken out at least 7.65% in taxes, meaning they would have deducted 1.45% in Medicare tax and then 6.2% in Social Security tax. So I would probably say that if you want to be able to, maybe do a decent amount, maybe look at maybe trying to put aside maybe 10% if you can afford to do it. If not, I would say at least the 7.65%. But yeah, just to be able to kind of give yourself some cushion. And then, of course, as your commissions grow and hopefully as your business begins to grow, then you can begin to start putting aside more.
Okay. One of the next questions is from an investor here in Texas. Texas has a Series LLC, and this individual has a Series LLC, and it gives them the ability to create multiple LLCs. The question is, since the Series LLC was created under one name and the individual LLCs that they create under that, does that give them the same type of asset protection as it would if they just bought the different LLCs instead of having that one series that creates the multiple different companies?
I think it still does, because again, if those individual LLCs, were created, again, it's still an LLC. From an asset protection standpoint, you would still have the coverage. It is separated from you as an individual. So okay. I think you're good.
We have some great questions coming. You definitely have to come back, Ms. Adina.
I definitely like that.
I don't know if you have any on your end, Vic, but I see quite a few coming through on my end here. I have another question. The topic is asset protection. This individual says they read that property should be under an LLC. The question is, up to how many properties should that person put under one LLC?
I would say, quite honestly, if you're going to do that, if you can afford to do it, try to put each individual property under separate LLCs, because that way, it's held separately. It's got its own tax ID number, and, it's just easier to be able to do that. Some people even choose to go ahead and put their vehicles in separate LLCs as well. So, you may want to consider doing that, especially if you can afford to do it and keep up with the paperwork, the reporting paperwork with the Secretary of State's office.
That just made me have a question. Why would I want to put my vehicle in an LLC?
Well, quite honestly, when you're operating a business, and if you're thinking that the majority of what you're going to be doing with that vehicle is going to be business related, make it a business asset. Okay. Why not?
Yeah.
Why not? To me, it would make sense. To be able to do it. And also too, considering you would also be able to probably write off a little bit more on your tax return, because it is indeed a business asset and not a personal asset. Mm-hmm. But again, you just have to be extremely careful in the case of potentially, having an audit making sure that making sure that that vehicle is indeed titled under the LLC's name, making sure that you are indeed keeping up maintenance and all of the other records that would have needed to be done, as well as making sure that you can't title it under the LLC's name and then it's listed as one of your personal vehicles on your business insurance. I mean, on your personal insurance.
Okay.
You want to make sure that everything is matching.
All things are matching. This is
yes.
Okay. I'm gonna stop talking. I'm gonna let you jump in.
No, you good. You good. It's all good. What I would say is, because we have so many people focused right now and tune in, this will be a great opportunity, Adina, to drop your contact information so that people can reach out to you, and they see your value tremendously. So give us all the ways that you would prefer to be reached.
Sure, no problem. Well, if you would be interested in booking a call with me, I do have an online calendar. So if you go to my website, which is www.fortitudefinc.com. So fortitudefinc.com. You can actually reach out and go ahead and book a call with me at your own convenience. My email address is fortitudefinc@gmail.com. You can also reach me actually through LinkedIn if you would like to connect directly with me on LinkedIn. It's under Adina Collins and then MBA. There's a couple of Adina Collinses that are out there. I was kind of surprised. So Adina Collins, MBA on LinkedIn. Also, Fortitude Financial Consulting has its own company page on LinkedIn as well. We are under Fortitude Financial Consulting also on Facebook, and also on Facebook, Pinterest, and on Instagram. So, please feel free to reach out to me. Definitely look forward to, hearing from y'all.
Absolutely. No, we really appreciate you doing this. And again, there is no doubt that we will invite you back on this show, because, this is the type of information that we really need. Absolutely. I mean,
I'd be glad to.
I recently read, there's 4 ways to really build wealth. Earn your money, save some money, invest your money, and then protect your money. And this covers that protect your money aspect of wealth building, because most people that get into the millions are not paying those huge tax burdens that many of the working class will end up paying. So this is the type of information that our community needs to hear, that we want to be able to share more often. So I really, really appreciate you taking the time to do this. And you actually answered one of the questions that I was going to have, which is about having, separate rental properties. What would be the wisest thing to do? And I've heard multiple times to just do a separate entity for each one of your properties. But I hadn't thought about the vehicles.
I hadn't.
Not under the LLC as well. So.
Different LLC. Yeah. I had not thought about the vehicle. That is happening.
Well, there's actually a really great quote that's out there. I believe it was one of the Rockefellers, and he said that you own nothing but control everything.
Yeah.
So if you were able to position yourself where you were literally controlling all of the assets, but you personally don't own a whole lot, how are you going to really tax me? And this isn't about tax evasion. I'm not talking about trying to purposely evade taxes. I'm just saying being able to take advantage of every legality that would be available to you to be able to protect, the things that you are investing in, and definitely the things that you want to be able to retain. So, hey, why not? And so one of the things that actually I would like to recommend to, to your listeners, to your viewers, if there are specific tax topics that you have, please go ahead and email the show. So the next time that I come back, I can already go ahead. I may not be able to get to all of them, but if you can go ahead and give me a certain amount of them, then at least I can go ahead and start doing some of the research. And so we'll definitely be able to hopefully address some of the more popular topics, and then anything else maybe we can do offline.
Absolutely. Well, I was going to ask you for one just golden nugget, but you just dropped it. Own everything. Own nothing, but control everything. And that is very powerful. And I know some folks have been doing that for a long time. So we might as well take advantage of that. Any last little thing you want to mention to the audience? We got your contact out there, but anything else before we wrap up?
Yes, actually, I would like to be able to say, listen, please, if you are on the old-fashioned maintenance regarding keeping your tax return information, your backup documents in a shoebox, in a paper folder somewhere. Y'all do know that paper does fade, right? Paper fades over time.
Yes, it does.
So literally, if you cannot prove that it happened, it never happened. Okay. So what I'm going to recommend that you do is listen, most of us have smartphones. You can take pictures, great pictures on your smartphone and be able to go ahead and start creating, documentation. Start scanning your information regularly. I don't care if you do it on a monthly basis. This will indeed be able to help you with that. And for any of y'all that are on QuickBooks Online, I know I use that for my clients. If you're on QuickBooks Online, the great thing is that you can scan and attach copies of either your picture files or the actual PDFs and be able to attach it to the transactions. How cool is that? It's already all in one place. And if you need to be able to go back, as long as you're keeping your information updated and you're keeping your subscription updated, then you should be good. The other thing I'm going to recommend too is that whether you decide to attach things physically into your accounting system, definitely make sure that you are storing it in a backup drive. I don't care if you use Google Docs. I don't care if you end up using Dropbox or somewhere else, even an external hard drive. Make sure that you are keeping detailed backup information. Again, we may not necessarily go 100% paperless, but whatever you can do to keep yourself better organized so you're not pulling your hair out, and also that you're staying in the good graces of the people that want to be able to help you to reduce your tax liability. Let's do that.
Okay.
Yeah, this is a great nugget. This has been an amazing broadcast, Miss Adina. Thank you.
Thank you. I appreciate it. Thank y'all so much for inviting me.
So much valuable information. Again, people are still getting comments that are questions that are coming through right now. Do what Miss Adina said on her. When we get to schedule her again, get your questions. Once you see our posting going out, the events come up well in advance on Facebook and YouTube and LinkedIn and all the various platforms. They come up well in advance where our guests will come on, formulate those questions, get those questions to us in advance so that we can do our very best to get those questions to our guests, and we can try to get those things answered in advance. I'm not ignoring your questions, but what we're going to do, because we are literally out of time. What we're going to do is, Miss Adina, if you could, there are some questions that are out there about changing from your personal name into LLCs. There's a couple of questions out there about that. If you could just, if you see those questions, if you want to address those in the comments on the Facebook post, then please feel free to do that. We will do our very best to get your questions answered. Again, we're not ignoring questions. We're kind of out of time. This is an amazing topic, and we really look forward to having you on again in the very near future.
Absolutely. It would be my pleasure. Thank you so much. I definitely appreciate it, y'all.
FortitudeFinc.com. FortitudeFinc.com. Fortitude Financial Consulting. This is Adina Collins. Find her, get in touch with her, reach out to us if you can't find it. But this is definitely a useful topic, and we really, again, appreciate you for coming. I apologize for my tardiness, but I'm about to go back and watch this whole show because, man, this is good stuff right here.
Everybody that's sharing watch parties, thank you so much. We've got questions from various watch parties, so I'll go in and put those questions under this feed so Miss Adina can see them. Thank you again for everybody on the watch party. Thank you again for our audience for joining us time and again each Monday at 6 p.m. Central Standard Time here on Create Your Future Self. And we look forward to seeing everyone again next Monday at 6 p.m. Take care.
Bye-bye.